Welcome at the Da Vinci Diligence channel. In today's episode, we have another interesting case that happened some time ago. Our mission is to educate people on how to avoid money laundering and terrorist financing. Every court case is an opportunity to learn from other people's mistakes and protect yourself from falling into the same trap. Enjoy the show and let us know if you have any feedback. In a landmark case highlighting the critical intersection of banking oversight and money laundering prevention, Banamex USA's story serves as a compelling warning about the consequences of inadequate compliance controls. The 2017 non-prosecution agreement between the U.S. Department of Justice and Banamex USA revealed how a subsidiary of banking giant Citigroup processed over $8.8 billion in remittances to Mexico with severely understaffed monitoring systems. Between 2007 and 2012, the bank's anti-money laundering team, consisting of just 2 employees, was tasked with monitoring millions of transactions while juggling IT responsibilities. This skeletal crew managed to file only 9 suspicious activity reports out of over 18,000 alerts, potentially missing countless illicit transfers linked to human smuggling, fraud, and drug trafficking. The case culminated in Banamex USA paying a $97.4 million forfeiture and contributed to the bank's ultimate dissolution, demonstrating the severe consequences of prioritizing business expansion over compliance infrastructure. This cautionary tale continues to influence banking compliance practices today, illustrating how inadequate controls and staffing can lead to both financial penalties and existential risks for financial institutions. Our story begins at Banamex USA, a California-based subsidiary of Citigroup that specialized in cross-border banking between the U.S. and Mexico. On the surface, Banamex USA appeared to be thriving, processing billions of dollars in remittances for people sending money to their families in Mexico. Between 2007 and 2012, they handled over 30 million transactions worth more than $8.8 billion, but beneath this successful facade, a dangerous situation was brewing. The bank's anti-money laundering team, which was supposed to monitor these millions of transactions for suspicious activity, consisted of just 2 employees. Yes, you heard that right. 2 people were responsible for monitoring billions of dollars in cross-border transfers. To make matters worse, one of these employees, known as BSA Employee Number 1, was forced to spend about half their time handling IT tasks like resetting employee passwords and creating new computer accounts. This left even less time for their crucial compliance duties. The bank's BSA officer had warned about this problem as early as 2004, telling management that mixing IT duties with compliance work was preventing them from properly monitoring transactions. Despite these warnings, Banamex USA continued expanding its money services business, MSB operations, adding new partnerships without strengthening its compliance team. Think of it like trying to monitor a dozen security cameras with one eye while fixing a computer with the other. Something was bound to be missed, and missed it was. Out of more than 18,000 alerts flagging potentially suspicious transactions worth $142 million, the bank opened fewer than 10 investigations and filed only 9 suspicious activity reports, SRs. To put this in perspective, these 9 reports covered just 700 transactions, totaling $341,300, a tiny fraction of the suspicious activity they should have been reporting. The consequences of these failures became clear through specific examples. Take beneficiary A, who received over $400,000 in suspicious transactions between 2005 and 2006, appearing on the bank's monitoring reports 12 times without any action taken. Even after finally filing a SAR on this person in 2007, They allowed another 248,811 in suspicious transactions to continue for another year without any follow-up investigation. Why were these failures so serious? Under the Bank Secrecy Act, BSA, banks are required by law to maintain robust anti-money laundering programs and report suspicious transactions that might indicate criminal activity like human smuggling, fraud, or drug trafficking. These aren't just administrative requirements, they're crucial tools for preventing criminals from using the U.S. financial system to facilitate their illegal activities. The situation finally came to light through regulatory examinations and investigations. In 2012, the Federal Deposit Insurance Corporation, FDIC, issued a consent order against Banamex USA for its BSA violations. When they conducted a look-back review of transactions between 2011 and 2013, the bank had to file over 1,400 additional SARs they had previously missed. The story's conclusion was costly for everyone involved. Banamex USA paid a $97.4 million forfeiture to the Department of Justice and a $140 million civil penalty to regulators. 4 senior executives faced personal penalties, including being banned from working in financial institutions and paying civil penalties ranging from $30,000 to $90,000. Ultimately, Citigroup decided to shut down Banamex USA's operations entirely. These violations were classified as crimes because they represented willful failures to maintain an adequate anti-money laundering program and to report suspicious activities as required by the Bank Secrecy Act. The term willful is important here. The bank's management knew about the compliance problems but repeatedly failed to address them, choosing instead to continue expanding their business despite the risks. This case serves as a powerful reminder that compliance isn't just about checking boxes. It's about preventing criminal activity that can harm communities both in the United States and abroad. When financial institutions fail to maintain proper controls, they don't just risk fines and penalties, they risk becoming unwitting accomplices to serious crimes. The total financial impact on Banamex USA came from 2 major penalties. First, there was a $97.4 million forfeiture to the Department of Justice. This amount wasn't arbitrary, it was calculated based on the bank's profits from its non-compliant activities. Court documents revealed that Banamex USA had earned at least $92.8 million in profits from these questionable transactions, so the forfeiture was designed to recapture these illegal gains and add a punitive element. But that wasn't the end of it. The bank also had to pay a separate $140 million civil money penalty to the Federal Deposit Insurance Corporation, FDIC, and the California Department of Business Oversight, CDBO. This penalty was determined through regulatory assessment of the violation's severity, duration, and the bank's cooperation level. The impact extended beyond just the institution to individual executives. The former CEO was hit with a $90,000 personal penalty and banned from banking. The former chief compliance officer faced a $70,000 penalty and similar ban, while 2 other executives received penalties of $30,000 each. These personal penalties were particularly significant as they represented one of the rare cases where individual officers were held financially accountable for compliance failures. In total, between the forfeiture, civil penalty, and individual fines, the case resulted in nearly $240 million in penalties. A stark reminder that the cost of non-compliance far exceeds the cost of maintaining proper controls. What makes this case particularly noteworthy is that these penalties ultimately contributed to the bank's complete dissolution, showing that compliance failures can have existential consequences for financial institutions. Let me share the critical lessons learned from the Banamex case, which provides a comprehensive blueprint for what effective AML/CFT compliance should look like. First and foremost, the case demonstrates the absolute necessity of maintaining proper staffing levels for compliance functions. Having just 2 people monitor millions of transactions was fundamentally inadequate. Financial institutions must implement a workforce planning model that scales compliance staff proportionally with business growth and transaction volume. This includes having dedicated BSA AML analysts who aren't burdened with non-compliance responsibilities. The case also highlights the crucial importance of technology and automation in transaction monitoring. Relying on manual paper reports to review millions of transactions is simply not feasible. Banks need to invest in sophisticated automated monitoring systems that can effectively flag suspicious patterns and unusual activities. These systems should be regularly tested, calibrated, and updated to reflect evolving money laundering typologies. Another critical lesson involves the escalation process. When compliance officers raise concerns about inadequate resources or controls, these warnings must be taken seriously by senior management and the board. The bank should have formal protocols for addressing such concerns, including specific timelines for implementation and clear accountability for follow-up actions. The case also underscores the importance of proper investigation and SAR filing procedures. Banks need robust processes to investigate alerts thoroughly, track suspicious activity over time, and maintain detailed documentation of decision-making. This includes implementing systematic follow-up procedures for previously filed SARs to monitor continuing suspicious activity. Perhaps most importantly, the case demonstrates that compliance cannot be sacrificed for business growth. Before expanding into new business lines or partnerships, financial institutions must conduct thorough risk assessments and ensure their compliance infrastructure can handle the increased volume and complexity of transactions. Lastly, institutions need strong governance frameworks with clear reporting lines and independent oversight of the compliance function. This includes regular board reporting on compliance matters, independent testing of controls, and ensuring that compliance officers have sufficient authority and resources to perform their duties effectively. These lessons teach us that effective AML/CFT compliance isn't just about having policies on paper. It requires adequate resources, robust systems, strong governance, and a culture that truly prioritizes compliance over short-term business goals. Hope you enjoyed today's show of the Da Vinci Diligence channel. We will soon release a new episode of our anti-money laundering and combating of financing of terrorism vlog. We really appreciate your suggestions or improvements. Please put them in the comments. See you next time.